Have you ever done everything right and still gotten punished for it? My name is Marcus, and I did. I had a credit card with a $6,000 limit. I charged $2,200 on it one month. Furniture, groceries, a car repair that showed up at the worst possible time. I had every dollar of it sitting in my checking account. I paid the full balance the moment the bill arrived. Zero interest, zero late fees. I did exactly what every single personal finance article in the history of the internet told me to do. 3 days later, my credit score dropped 31 points. I checked the app 3 times thinking it was a glitch. I called my bank. I filed a dispute with the bureau. And somewhere in that process, a customer service rep said something that stopped me cold. "Sir, there is no error. Your balance was reported correctly." "But I paid it off." "Yes, but you paid it after the reporting date." I had never heard those words in my life. Reporting date. Not due date, not payment date. Reporting date. A date that nobody ever told me existed. A date the bank knows, a date the credit bureau uses, a date that was quietly shaping my financial reputation every single month without my knowledge. Here is what most people never figure out. Your credit score is not watching what you do with your money. It is watching what your money looks like on one specific day each month. And the banks know exactly when that day is. They just don't go out of their way to tell you. By the end of this video, you will know that date, what to do with it, and the exact reason the system was built this way in the first place. Because once you understand who benefits from you not knowing, the whole thing starts to make a different kind of sense. Before we get into the mechanics of this, let me ask you something. When you picture someone with a credit score in the mid-600s, someone struggling to get approved for a decent rate, what do you picture? You probably picture someone who missed payments, someone who maxed out their cards and never paid them down, someone who is genuinely financially reckless. Now, here's what I want you to consider. A significant portion of people stuck in that range are not financially reckless. They are financially invisible. They're doing things that look like responsibility, paying their balances, using cards for everyday purchases, paying them off monthly, but doing them in an order that the algorithm reads is risk. The truth is, the credit score is not measuring whether you are good with money. It is measuring whether your money looks good on one very specific day each month. And until you know which day that is, you're letting a snapshot of your worst moment define your financial identity. But here is something that most people don't realize about the way credit bureaus actually receive your data. They are not watching a live feed of your accounts, not even close. They receive a transmission once a month on a date determined by your card issuer, and that transmission contains one number, your balance on the day the transmission was sent. That's it. That is your credit report for the month. One balance, one day, no context. Think about it this way. Imagine someone was writing a biography of your financial life, but they were only allowed to take one photograph per month. And that photograph was always taken at the moment you had the most money going out of your account, right in the middle of a pay cycle, right after a big purchase, right before you sat down to pay everything off. Every month, that photograph gets sent to 3 different agencies who use it to decide whether you were trustworthy enough to lend money to. They never see the photograph from the day after, the one where everything is paid, the one where your balance is zero and your financial life looks exactly as responsible as it actually is. It feels like being judged on the messiest hour of your week instead of the cleanest. It feels like a professor grading your notebook on a Tuesday afternoon before you've had a chance to organize your notes from Monday's class. It feels like someone reading your text thread in the middle of an argument and deciding that's who you are as a person. It's a partial snapshot presented as a complete truth. Here's how the timeline actually works. Your billing cycle runs for 30 days. On the last day, called the statement closing date, the bank freezes your balance, generates your statement, and sends that number directly to Experian, TransUnion, and Equifax. That number gets hard-coded into your credit report. Your actual payment due date is usually 21 to 25 days after that closing date. So if your cycle closes on the 15th and your balance is $2,200, the bureaus receive $2,200 as your balance. When you pay the full amount on the 5th of the next month, perfectly on time, perfectly responsible, the bureaus already have their number. They don't update it. They don't care that you paid. They just wait for next month's transmission and do the whole thing again. According to the Consumer Financial Protection Bureau, this reporting lag is one of the most common sources of confusion among consumers who dispute their files. People see a balance reported that they already paid. They assume it's an error. They call the bank, they file a dispute, and the bank tells them exactly what the rep told me. It is not an error. It is the system working exactly as designed. Here is where things get really interesting. Your credit utilization ratio is the balance in that snapshot divided by your total available credit. FICO data shows the scoring model treats utilization in tiers. Below 30% is considered manageable. The moment you cross 30%, the model flags you as elevated risk. Cross 50% and you move into what I call the panic zone. The model starts treating you the way a lender treats someone who has missed payments. And if you hit 90% or above, your score goes into actual free fall, sometimes 50 to 80 points in one reporting cycle. But here's something that most credit content will never say out loud, because this is where the math stops being accidental and starts looking like architecture. The statement closing date is known to your bank. It is set by your bank. In many cases, it was set without your input on the day you opened the account. The three major credit bureaus, Equifax, Experian, and TransUnion, are private companies. Their primary revenue comes from selling your credit data and scores to lenders. According to SEC filings, Equifax alone generated over $5 billion in revenue in a recent year, with the majority coming from banks and lenders paying to access your file. The Bureau's customers are not you. The Bureau's customers are the institutions that lend you money. And those institutions benefit when your score is lower because a lower score justifies a higher interest rate. Nobody in the chain profits when you understand how to optimize your reporting date. The lender makes more money when you don't know. The Bureau gets paid regardless, and the scoring model was designed by Fair Isaac Corporation, whose primary clients are those same lenders. The person approving your mortgage application is working from a score generated by a model built for the benefit of the company approving your application. Nobody in that room built the FICO model to maximize your score. They built it to minimize their risk. Those are not the same thing, and the gap between those two things is where your interest rate lives. Here is where things get really interesting. Because the mechanics of fixing this are not complicated, they're just specific, and specific is exactly what the general advice always leaves out. You need to know the closing date of every credit card you own. Not the due date, the closing date. To find it, go into the app, navigate to the Statements section, and open an actual PDF of a past bill. Look for Billing Period or Statement Period. The end date of that period is your closing date. Once you have that date, set a calendar reminder 3 days before it. 3 days because bank transfers can take 1 to 2 business days to post, and you want the payment fully cleared before the statement generates. On that reminder day, log in, look at your current balance, and manually pay it down to under 10% of your limit. Do not wait for autopay. Autopay was designed to protect you from late fees. It was not designed to optimize the number the Bureau sees. If you leave your score management on autopilot, the autopilot will keep flying you into the same wall every month. Go under 5% if you are 60 days out from a major loan application, but not to 0. Here's why. FICO's own research on people consistently above 800 shows they average 4 to 7% utilization, not 0. The model is designed to score how you manage credit. If the snapshot shows 0 every single month, it has no data to work with. The optimal state is what credit analysts call all 0 except 1. Every card at 0 except one card carrying a tiny balance of around 1% of its limit. That tells the algorithm you use credit and keep it completely under control. It is the highest scoring configuration the model knows how to reward. Let me show you exactly what I did. My starting score was 690, available credit $6,000, reported balance $2,200, 36.6% utilization. Step 1. I requested a credit limit increase on my primary card. No new account, no hard inquiry for an existing customer request. My limit went from $4,000 to $9,000. That same $2,200 balance dropped from 55% utilization to 24.4% overnight without moving a single dollar. Step 2. 3 days before my next statement close, I paid my balance down to $95. The statement reported $95 on a $9,000 limit. Utilization 1.05%. 32 days later, my score moved from 690 to 731. 1 month, 41 points. And here's what 41 points actually means in real money. On a $300,000 mortgage, that increase translates to approximately $22,000 in interest savings over the life of the loan, not per year, over the entire loan. I changed nothing about my spending. I changed nothing about my income. I moved 2 payments earlier on the calendar. That is the entire difference. We have built an entire industry, the credit repair industry, that generated over $4 billion in revenue in a recent year. $4 billion paid by American consumers to learn information that is public, free, and something the bureaus are legally required to explain upon request. Credit repair companies charge between $500 and $2,000 to do what amounts to reading your own credit report, identifying errors you are legally entitled to dispute for free, and timing payments to a date printed on your own billing statement. If someone told you they were paying $1,500 to have someone remind them to pay their bills 3 days early, you would question that. But when it's packaged as credit repair and sold with urgency and legal-sounding language, somehow $4 billion a year leaves people's hands. The error is free to make, the fix costs $1,200, and the entire transaction is made possible by the original system being deliberately opaque about how it works. So here's the advice, simple and specific. This week, find your statement closing date, just one card, log in, pull up a past statement PDF, and find the end date of the billing period. Put it in your calendar 3 days early. That is the entire first move. It costs nothing. It takes 8 minutes, and it's the difference between the bank photographing your finances at the worst moment of the months versus the best. Most people never take those 8 minutes. They keep losing tens of thousands of dollars on loans because nobody told them which date actually mattered. The system was designed by people whose clients are lenders, operated by companies that profit from your data, and explained to consumers in the least specific terms possible. That is not a broken system. That is a system working entirely and deliberately for someone other than you. You do not need to pay anyone to navigate this. Know one date, pay your balance 3 days early, leave a small balance on one card instead of going to zero. That's the whole protocol. That's what the $1,500 credit repair session teaches you. The game has rules. Most people are simply never told what they are, but the rules are the same for everyone, which means once you know them, you're not trying to cheat anything. You're finally playing the same game as everyone who already has an 800. Because once you understand how the credit reporting system actually works, it becomes pretty clear that the only thing separating a 690 from a 760 is simply knowing which day of the month actually matters.